Fixed-rate mortgage. The mortgage that never changes, and why that matters. What if your biggest monthly expense never changed? No surprises. No sudden increases. Just consistency. That's the promise behind a fixed-rate mortgage. But is stability always the best option? Or could flexibility actually cost you less in the long run? A fixed-rate mortgage is a loan where your interest rate stays the same for the entire life of the loan. That means your principal and interest payment remains consistent month after month. Whether it's a 15-year or 30-year loan, the rate doesn't change. This matters because it creates predictability. You always know what your payment will be, which makes it easier to budget, plan long-term, and avoid financial surprises. In an environment where interest rates can rise, stability becomes valuable. But here's the trade-off. Fixed-rate mortgages often start with slightly higher rates compared to adjustable-rate options. So you're paying for certainty. The question becomes, is that certainty worth it for you? A fixed-rate mortgage is not just about safety. It's about alignment. If you plan to stay in your home long-term, locking in a rate can protect you from future increases. But if your timeline is shorter, other options may provide flexibility. Imagine two homeowners. One locks in a fixed rate and stays for 15 years. The other chooses a variable rate and experiences rising payments over time. Same starting point. But one has predictability, the other has uncertainty. Here's your next step. Ask yourself, do I value stability or flexibility? How long do I realistically plan to stay in this home? Because the right mortgage is the one that aligns with your strategy. A fixed-rate mortgage gives you consistency, but the real power comes from choosing the structure that fits your long-term plan.